We have hit 63 consecutive months of inflation running above 2%. That sustained pressure is quietly driving the 10-year Treasury yield up from around 4.4, straight toward the 5% threshold. During a recent tech sell-off, the headline S&P 500 dropped 4.5%. But under the hood, over 400 non-AI companies in that very same index were actually rising in value. Retail investors see a 5% yield and panic, assuming higher rates will automatically crush equities. Institutional capital does the opposite. They use those yields to lock in reliable returns, shifting into a disciplined 4-5-6 allocation strategy. Buying the whole index right now masks a massive internal rotation. The smart money is actively moving out of concentrated mega-cap tech and flowing into the broader, yielding market. We are firmly inside a global rate hiking cycle. The central banks in Japan, Australia, and Europe have all recently raised rates, leaving the Federal Reserve no choice but to follow suit. This chart shows exactly why the Fed is pinned. Plunging headline oil prices are a distraction. Core PCE inflation is stuck at 3.4%, matching the Fed funds rate at 3.6, giving a near-zero real rate. To combat sticky inflation, the 10-year yield will climb from 4.42 toward 5%. When the Fed raises short-term rates to fight inflation, it signals to bond investors that the central bank is taking the threat seriously. The panic subsides, and long-term yields stop spiraling out of control. This split chart reveals a tale of two markets. In early June, the narrative claimed the economy was slowing, as the primary index dropped. But looking at the right side, the 400 non-AI companies actually went up during that exact same period. This pie chart quantifies the underlying risk. AI-affiliated equities now make up 48% of the S&P 500. We haven't seen a market concentration this extreme since railroads dominated the 19th century. This chart maps out the Gartner Hype Cycle. Mega-cap tech companies are borrowing tens of billions of dollars to overbuild data centers, placing us right here on the initial technology trigger slope, much like the internet in 1998. The underlying AI technology has practical utility to replace costly corporate software. But because market valuations are heavily front-loaded, investors will face severe cyclical drawdowns before the sector reaches true maturity. After 15 years of development, decentralized finance tokens still operate purely as speculative instruments. They lack the practical financial infrastructure to compete with established firms like JP Morgan or Charles Schwab. The only true utility found in the blockchain space right now is stablecoins. In hyperinflated, dollarized economies like Venezuela, citizens effectively bypass their broken local currency by conducting daily commercial transactions in Tether. To build a legitimate alternative financial system, blockchain networks must improve transaction speeds and user interfaces. Until that happens, standard altcoin speculation is entirely irrelevant to smart money. When the 10-year yield holds near that 4.5% resistance level, it acts as a catalyst. Capital naturally fractures away from concentrated tech megacaps, rotating into the broader traditional economy. This chart outlines the institutional 4-5-6 rule. Capital is being repositioned to capture a realistic 4% return on cash, 5% on bonds, and 6% on non-AI equities. Investors have grown accustomed to throwing darts at tech stocks and expecting automatic 20% returns. That cycle is over. Success in this environment requires aligning your capital strictly with what the structural data actually yields.